Rupert, if we were to asset allocate to bonds, it makes no sense to our viewers or listeners to acquire a negative yield. Yesterday, I saw Swiss 20-year negative yields. What's different of this negative yield in 2019 versus the negative yields of 2016?
Well, they're driven by the same thing, which is risk aversion and a flight to safety. And I think that you probably want to fade recent falls in bond yields around the world. It comes back to really the discussion you were having with Francine earlier about German unemployment versus this terrible and persistently terrible global trade data coming out of China, coming out of capex numbers, manufacturing numbers. And the market, I think, has overreacted to the manufacturing cycle, is extrapolating a much more serious slowdown that's driving these flight to safety combined with dovish central banks. I would put much more store by these resilient labor markets,
right.
Pretty benign inflationary environment that is going to underpin consumer demand, and I think you will see the manufacturing cycle catching back up to much more resilient domestic economies.
Well said, but then what do you do tactically with an asset allocation if you're predicting lower fixed income prices and higher yields? Do you radically adjust?
I think you probably want to move a little bit out of government bonds. I think we still like owning treasuries in particular in multi-asset portfolios because they're still going to act as a diversifier, and you will get that negative correlation with equities in the scenario that you really need it. But I think you want to move a little bit out of bonds. I think we still want to lean into risk assets. Obviously, we've had a massive rally year to date, so the upside from here is inevitably going to be smaller, but we want to own some risk assets. I think that we are also looking for a bit of a rotation. I think we see cyclical stocks, particularly in Europe, are looking under-owned, looking undervalued. I think we could see a little bit of a rotation into cyclicals, into value, and in Europe, where the pessimism is really, I think, overdone, you could see a little bit of a bounce relative to the rest of the world.
Rupert, what do the moves in bonds over the last week actually tell us about the impending recession? I know everybody says, no, this time it's different, but actually, how can we be so sure?
Well, let's be clear, the bond moves don't tell us anything magical about predicting the future. They tell us what investors are worried about. And investors are worried about the end of the cycle. And in a sense, this is becoming a little bit self-fulfilling because everyone's so focused on the yield curve. The inversion of the yield curve has been a pretty reliable predictor. It's making people think that maybe they should pay attention to these repeated downside surprises coming out of the global trade cycle, manufacturing data, and weak earnings revisions that we've seen over the recent period. I think that we need to have a little bit more conviction in the fact that labor markets are very strong. Domestic demand in the US is going to be okay. Domestic demand in the Eurozone is going to be okay. China is bottoming. The global growth situation, I think, is going to remain relatively stable. Of course, everyone has been surprised by the extent of this weakness coming out of China principally, but also in Europe on manufacturing. I think we are looking for that to bottom, and I think that could underpin quite a big rotation in markets.
Should we not worry about central banks just not having enough tools to deal with the next impending recession, which could come, in the next 18, 24 months?
I think we should worry about that a lot. I just don't think that's going to be the driver for markets over the next few months. I think we should worry about that a lot on a longer-term basis, particularly in Europe, where the ECB says we have all these instruments available, we just can't tell you what they are. I think the political barriers to a plan B in Europe in particular are massive. So I think the problem there is more about a longer-term concern.
Rupert, as you well know, and I'm sure with an asset allocation of BlackRock, the underperformance of financial stocks and banking in particular was a 2018 event. Does it carry over into this year?
I think there is a tactical opportunity in banking stocks, particularly in Europe. I'd frame that within this possibility that we get a bit of a rotation back into cyclicals just because they're so beaten down. The yield situation has been really driving down European banks, and also the kind of pessimism about the European outlook. So I think there is a tactical opportunity in terms of allocating a little bit more to financials, and particularly in Europe. I still struggle to see the strategic case for investing in a lot of these European banks. So I think if you're willing to take a tactical view, look for a short-term bounce, that's a good trade. If you're trying to set a long-term strategic asset allocation for your portfolio, it's a pretty hard case to make.